Welcome back to the show. Great to have you with me today. It's Thursday, March 19th. The Fed starts a two-day meeting today, ends tomorrow afternoon at 2 p.m. We'll decide whether or not they're going to raise or lower the federal funds rate or leave it unchanged. They will leave it unchanged. It's my forecast. Federal funds rate is the overnight rate, shortest rate on the yield curve. For borrowing lending reserves, Fed's expected leave rates unchanged right now. The federal funds rate is 5.25 to 5.5% right now. I'm calling to the Fed to be on hold at least through their June meeting. They have an April meeting, their April 30th and May 1st meeting. Then they have a meeting in June. I'm calling for no change in rates at least through June. We'll see a lot of data between now and then, make some assessment about the remaining meetings in 2024. Watch the policy statement at 2 o'clock as always for hints about what the Fed is thinking about future decisions. Every word will be parsed by financial markets to determine what will happen. Now, I want a little shout out to my friend Cam for keeping me on my toes. Just want to make sure we understand when I talk about the federal funds rate. It's a very complex system, the federal funds market, and management of reserves generally. And it changed quite markedly after the Great Recession in 2008, 2009. And the changes reflect changes both at the Federal Reserve and at the Federal Deposit Insurance Corporation. The FDIC, as you know, insures deposits for America's banking customers, and banks fund that insurance policy, and that was changed in 2008, 2009 after the Great Recession. And so we want to talk about the federal funds rate in a way that's a little different from what I normally do talk about it. Generally speaking, the federal funds rate is the overnight interest rate used by commercial banks in the United States to manage their daily reserve requirements imposed by the U.S. Congress on the Fed and therefore on the banks themselves. However, unusual monetary policy since 2008, 2009 changed that landscape markedly. And it was zero interest rate policy by the Federal Reserve that really changed the federal funds market. So the federal funds market before the financial crisis was an interbank market where banks borrowed and lent money to each other overnight, and the action of managing their daily reserve requirements, again, set by the U.S. Congress, imposed by the Fed. And while the Fed sets the target rate for the federal funds market, the actual funds rate, the effective rate, is determined by the borrowing and lending in the federal funds market. The financial crisis led to big changes in the funds market. It was caused by three major developments. First, the Fed balance sheet expanded in size. New banking regulations were enacted by the FDIC in terms of how much cash banks had to hold, essentially replacing reserve requirements. And the Fed began to pay interest on banks on funds they held in the reserve accounts at the Fed. Since that time, the effective federal funds rate has been consistently lower than the interest on excess reserves. And so today, because banks can earn risk-free interest on their excess reserves at the Fed, the primary users of the federal funds market now are government-sponsored entities like Fannie Mae, Freddie Mac, and the federal home loan banks. They're willing to accept the rate in the federal funds market that is lower than the interest on excess reserves offered by the Fed. And so now that the Fed and the FDIC have unilaterally enacted policies that have decreased the role of domestic institutions and therefore increased the role of foreign institutions, the link between federal funds policy and the real economy is far more complex. So when a target rate increase is announced for the federal funds rate, it's accompanied by an increase in the interest on excess reserves rate. And the current interest on reserves is 5.4%, right between the 5.25 to 5.5% range for the federal funds rate. I think it's still okay to call the federal funds rate the overnight rate. Banks use to manage their reserve requirements use a lot less. Reserve requirements are not a big factor any longer. Again, overtaken by FDIC regulations. But the federal funds rate is still the primary tool used by the Fed to impact economic activity, borrowing, and investment. So let's check on some data. Starting with last Friday, we had the New York Empire State Manufacturing Index out for the month of March, down 20.9. This is an index, so below zero is very bad. Worse than expected and worse than February. Manufacturing in the New York State region continues to be impacted negatively. Also had the February capacity utilization rate and the February industrial production. Capacity utilization is the percent of our capital stock in use. 78.3 versus 78.5 expected versus 78.3 in January. Low levels. A lot of excess capital in the United States. Think trade policy. February industrial production up 0.1%, a little higher than expected and better than January. Also, we had the March Michigan Consumer Sentiment Index, 76.5, looking for 77.1, against 76.9 in February. It's a little weaker. Reversal in these sentiment indexes now for a couple months as inflation remains and unemployment begins to rise. No data yesterday, Monday. Today, Tuesday, we had February housing starts up 10.7%. Holy cow, what a number. 1.52 million units were created in the month of February on an annualized basis, way higher than expected, way higher than the prior period. Housing starts are foundations in the ground. Other data to pay attention to for today later on, I won't cover it now, will be the overall net capital flows for the month of January. It comes from the Treasury International Capital Flows data. The appetite on the part of foreign nationals to invest in corporate bonds or U.S. government bonds. And again, as I indicated, the Fed meeting starts today, FOMC, ends tomorrow, Wednesday at 2 p.m., expecting no change in rates. Let's take a quick look at markets before we head out. Again, a snapshot, just a snapshot. We'll start with the mania that is Bitcoin. 63,634 a coin, down 3,533 from yesterday. The Ponzi scheme that is Bitcoin. This is a joke. Creates no value, adds nothing. If you are someone concerned about global warming and you think there's a remedy to global warming, if you believe the whole narrative about global warming and what needs to be done, then you cannot support Bitcoin. What a scam. Checking other markets. S&P 500, 5,149, up 32 for the day. Still near all-time highs. Must be speculating on some dovish commentary from the Fed tomorrow when they announce their interest rate decision. Dow Jones Industrial, 38,790, up 75. The Nikkei, 40,003, up 263 points on the back of news that the Bank of Japan is finally done with negative interest rates. Hey. What a joke negative interest rates were. Monetary policy is conducted from 2008 to 2022, 2023 across the world, led by the Fed, has been a disaster. Lost their credibility, quite frankly. Check on the U.S. interest rate, our benchmark, the U.S. 10-year, 4.3%, down 3 basis points. It's okay, moving in the right direction. We want to move towards 450 for sure. Japanese 10-year, 0.733. How about that? Checking on commodities, West Texas oil, NYMEX, 82.81, up 9 cents. Elevated nat gas, $1.75, up 5 cents. Gold down small, 2,159. Gold and crypto, the hedge against uncertainty. I'll take gold. Gold has value. Gold can be used for something. Crypto, Bitcoin, scam, Ponzi scheme. Checking currencies. US dollar index 103.91, up 48. Stuck in a range here. Really range bound in currencies. Dollar yen 150.54. Holy cow. Stronger dollar, weaker yen. Sterling against the dollar 126.90, down small. So weaker sterling, stronger dollar. Euro against the dollar 108.50, down 20. Weaker euro, stronger dollar. Stronger dollar remains the theme. Buy dips in the dollar. Sell rallies in stocks. Sell rallies in bonds. Sell rallies in commodities. That's the call. All right, that's all I have for you today. Always try to buy American.